Class, now we've looked at the basics of accounting, and now you have a little bit of an idea of what the accounting equation is. It's asset equals liabilities plus equity, or stockholders' equity if you're a corporation. Now, in the last unit, we looked at how to analyze the transaction, and we looked at the analysis, and we looked at the transaction and decided how did that transaction impact our accounting equation. Did it impact assets, liabilities, or equity, and how did it impact it? Well, now we need to move on into debits and credits. Now this is going to be a little bit more difficult than the simple analysis. So you really need to focus and see if you can concentrate and learn the rules of debits and credits. It's crucial. We will use debits and credits in all accounting topics going forward. So you really need to focus in and learn debits and credits. So let's look at some items and see if we can figure out the rules of debits and credits. So to start, let's review the steps that we've covered so far in the accounting. First, we analyze the transaction. That's step one. Step two, we record that transaction. And step three, we summarize it. And summarize means post. So step one, we analyze. We see how it impacts the accounting equation. Step two, we record, and we record in the journal. And then step three, we summarize. We post to the ledger. So let's look at recording business transactions. When we analyze transactions, we used a plus and a minus to show impact on each type of account. Do you believe this is a logical way to record our transactions? Well, while it makes sense, it may be illogical, it is not a proper means of recording transactions. Could you imagine a business handing you a spreadsheet that just has a plus and minuses all over it? It doesn't look very professional. So instead of doing plus or minus in a spreadsheet type form, we actually record transactions in what we call a general journal. A general journal is a chronological listing of all transactions that impact the accounting equation. But before we can record in the journal, there's a new concept we must learn and understand, and it is the concept of debits and credits. Well, the term debit simply means left. Some people want to say debits plus or debits minus. That's not true. A debit is neither a plus nor a minus. It is both a plus and a minus depending on the account. So what you have to think of is debit means left. Credit then means right. So you need to follow through and look. Debit means left, credit means right. A debit is abbreviated DR and a credit is abbreviated CR. Now those abbreviations come from their Latin roots. Notice the word debit has no R in it, but the Latin root did, so we ended up doing a DR for the abbreviation for debit. So let's look at the accounting equation again. Now the accounting equation says assets equals liabilities plus stockholders' equity. Notice how there is a left side to the equation and there's a right side. Left side would be our assets. The right side would be liabilities and stockholders' equity. So based on this information, now we know a debit means left, and we know there's a left and right side of the equation. So does a debit or a credit increase assets? Well, again, debit means left, so everything on the left side, which is our assets of the equation, is increased with a debit. Now credit means right. So what's on the right side? Well, liabilities and stockholders' equity is on the right side of our transaction. So based on this, does a debit or credit increase liabilities and stockholders' equity? Well, we know that it's on the right side and credit means right, so everything on the right side of the equation must be increased with a credit. Okay? Now you're like, I'll never remember this. I mean, logically it makes sense. How can I remember this? Well, let's look at an acronym that may help. So bear with me. I'm going to scroll all the way down here to the bottom, and I'm just going to type in a little acronym really quickly. I call it CLEAR DAY. Now, granted, neither clear nor day is spelled properly, but that's okay. It's an acronym. It's just a group of letters that help us remember. So CLEAR, CLR accounts. CLEAR accounts, CLR accounts. What does that stand for? Well, C stands for contributed capital. That's our owner investment into the company. L stands for liabilities. And R stands for revenues. Now notice CLR, clear, begins with the letter C. So these types of accounts are increased with a credit. Clear accounts are increased with a credit. So if you can look at an account and you can say, oh, that account is a liability account, Now you know that a liability is increased with a credit because it's part of clear accounts. If it's increased with a credit, then it must be decreased with a debit. Okay? So now let's look at the other side, and that's the day side. So clear day. Day starts with our D, so D stands for dividends. Dividends are increased with a debit. Now, granted, dividends are an equity account, but remember, dividends reduce equity. So the more dividends you have, the less equity you have. So it's sort of a contra equity account, so to speak. Not that we call it that, but you can think of it in those terms to an extent. All right. Now, dividends are first. Our next is A, and A stands for assets. Asset accounts are always increased with a debit. And then our E is our expenses. Now, expenses are also an equity account. So you're like, wait a minute, everything on the right side is increased with a debit, or a credit, excuse me. Correct. Stockholders' equity accounts are increased with a credit. But an expense is by default a reduction to stockholders' equity. So we're reducing stockholders' equity. So the normal balance of an expense would be a debit. Again, day starts with D. These accounts are increased with a debit. If they're increased with a debit, then we would decrease them by crediting the accounts. Okay? So keep this little acronym in mind and see if you can always bucket your accounts into one of those six. And sometimes that helps us with the rules of debits and credits. So let's look at some transactions. So we're going to go up here and go back over those same three transactions. Remember in the last video we looked at three different transactions. We're going to look at those same three transactions and see how we would translate them from an analysis where we look at how they impact the equation into journal form. So let's look at this. Patricia Johnson incorporates Healthy Habits Incorporated on September 1st. The company issues stock Patricia in exchange for her contribution of $100,000 to the company. Now, do y'all remember how we analyze this transaction? We need to pull out the accounts that are necessary. Remember, we're looking only at Healthy Habits, our company. Now, our company is receiving $100,000. So what does that mean? Well, we're receiving cash. What type of account is cash? That's right, it's an asset. So in this case, our assets are going up. So remember in our last lecture, we said cash would go up by $100,000. Now, what else would go up? Well, the owner is contributing money. Remember, when owners contribute money, we call that contributed capital. Contributed capital is always part of stockholders' equity. Remember, stockholders' equity is comprised of four components: contributed capital, dividends, revenues, and expenses. So what's happening to our owner's claims? Well, our owner gave money, so their claims are going up. So $100,000 is going up in the form of contributed capital. Now, hopefully you're getting a grasp on how to analyze these transactions, and hopefully you're getting a grasp on how to pull the accounts out of the transaction. Now let's convert this into a transactional analysis, and let's see how does it impact our journal. How would we physically record this as debits and credits? Well, what's happening to our cash account? Our cash account is going up by $100,000. We said that cash is an asset. So based on what you know to this point, how do we increase assets with a debit or credit? We increase assets with a debit. It's part of our day accounts, and they're on that left side. So first thing we need to do is record our debits, and cash is our debit. So we're going to debit our cash account for the $100,000. Now, for every debit that we create, there must be an equal credit. We must always be in balance. So every debit has to have an offsetting credit. Well, let's talk about contributed capital. Contributed capital is on the right side, and contributed capital is going up, which means our stockholders' equity is going up. Based on our little acronym, contributed capital is part of the clear accounts, and clear accounts are increased with credits. So we need to go in and we need to credit our contributed capital. And we're going to credit it for the $100,000. Now notice this one thing, and I want to be very specific here: good journal form. Good journal form is important. It really saves you a lot of time in the long run as an accountant. So if you will debit cash, or here put your debits first, followed by your credits, and always indent your credits. This is neat. It's easy to review. If you need to review, it's easy to find breaks if you have everything in a neat, orderly fashion. Okay? And then the next thing you would do is leave a blank line and then do your next transaction. We'll talk a little bit more about that later. All right, so let's look at the next transaction. Healthy Habits Incorporated borrowed $50,000 from a local bank on September 12th. The company signed a formal agreement to repay the balance. Now, again, we're borrowing $50,000, so what does that mean? What's our company getting? That's right, they're getting cash. And remember when we analyzed it, we said that cash was increasing by the amount we borrowed, $50,000. What else did we say is going on here? Well, when you borrow money, you owe money back to the bank. And remember we said when you owe something, that's a payable. If it is an official document, a signed agreement, then we call it a notes payable. So since it's something owed, it's a liability. Our liabilities are going up in the form of a payable, and specifically it's going to be a note payable. All right. So we've analyzed the transaction. We know our assets are going up. We know our liabilities are going up. Now let's translate that into general journal form. Let's translate it into debits and credits. Now assets we said are going up. How do you increase an asset account, debit or credit? That's right, you debit the account. So remember, debits must go first. So I'm going to debit my cash for $50,000. Now by default, we know we need to credit an account. But let's walk through it anyway. A note payable is a liability account. Our liabilities are going up. Based on our acronym, how do we take it up? Well, liabilities are part of clear accounts, and clear accounts are increased with a credit. So we need to increase the note payable account by crediting the account for $50,000. Again, we are in perfect balance. Debits of 50, credit of 50. Perfect. All right, let's look at one more. And this was where we purchased the equipment on September 20th for $25,000. We paid $5,000 down and we placed the remainder on account. So now remember we said this impacted 3 accounts. And the first thing was we purchased equipment. Notice equipment, and how much did we pay for the equipment? We paid $25,000. So we said that our equipment would go up by $25,000. And we did say equipment was an asset because it brings us future benefit. Now, how did we pay for this equipment? Well, there's a 2-step process. We did pay $5,000 down. When you put money down, what is that? That is cash that you're paying out, right? So that tells us our cash is being paid out. And when we pay out cash, our cash goes down. Cash, again, we've already determined is an asset. It's something we control that brings us benefit. So it's going down. Now, at the moment, we're not in balance. We have $20,000 in asset change, but we have nothing to offset that. So what's the rest of this? Well, it says we place the remainder on account. So that means we owe money for the rest. And when we owe money, a lot of times we call that what? A payable. What type of payable? Well, it doesn't say that it's a formal document. It says on account. So that means it's an accounts payable. So our liabilities we've determined are going up, and they're going up by the amount we still owe on the equipment, $20,000. And we've determined that that is a payable, and we're calling it account payable or accounts payable, either way. All right, so we analyzed the transaction again. Now let's translate that analysis into debit and credit form. So on September 20th, what are we going to debit? Well, our debits go first, so let's talk about this. Is equipment a debit or credit? It's a debit. Notice our equipment is going up. It's an asset. To take assets up, we debit the account. So I'm going to debit equipment for our $25,000. Now we must put all debits together before we do any credit. So are any other accounts being debited? Well, let's just double check. Cash. What's happening to cash? Cash is going down. So we increase cash with a debit. If we need to decrease cash, we're going to credit the account. Now on the flip side, let's talk about the payable. Is it going to be a debit or a credit? Well, payables are liabilities. Our liabilities are going up. So do we debit or credit the account? That's right, we're going to credit the account. So we do not need any more debits. We just need to credit these 2 accounts. So we're going to go in and we're going to credit cash for $5,000. And I apologize, I did not leave y'all enough lines. So go 1 line more and we will credit our account payable here for 20. Notice we're still in balance. We've got a debit for $25,000 and we've got total credits of $25,000. Notice how I indented, but I indented them both the same. Once you indent a credit, you don't have to continue indenting. You indent and all your credits are lined up. All right. So let's review this really quick. And this is our journal. This is what it would look like after the fact. Now I changed this transaction a little bit, so let me fix this. And it is account payable. And we said that would be our 20,000. So this is sort of analysis of the three transactions, the chronological listing of our transactions. Notice good journal form, debit first, followed by credit. Credit is indented, and then we leave one blank line. Now we do omit explanations in here, so you do not have to worry about the explanations. Hopefully this video has helped a little bit clarify debits and credits. I highly suggest that you use an acronym that will help you remember the rules of debits and credits so that you do not get them confused. If you have any questions, let me know. Have a great day.